STAKK Nation, welcome back to the channel. So it's a beautiful thing to have you all here. Thanks for watching. Now, here's the good news. Inflation has ended.
Say what?
Actually, let me pull this up here.
Jeremy.
Jeremy Siegel said inflation is basically over. Who is this guy?
Oh man, the biggest economist of them all.
Who is my biggest economist of them all, man? There is no such thing as the biggest economist of them all.
Jeremy Siegel was what made what's it called? Clinton's presidency pop, man. That guy was smart.
Is he? I don't know, man.
Oh jeez.
I think that, listen, every now and then some people can get some calls right, but the idea that inflation is over,
I don't
and
think
his
it's over.
reasoning behind it is on shaky grounds. Let me dive into it here. The stock market is poised for a significant year-end rally. Inflation is basically over. Wharton professor Jeremy Siegel says. This article is from Yahoo Finance.
Hey, your uncle uses Yahoo Finance for his investment, and it does pretty well.
Hey,
At least he
listen,
doesn't
man.
use Kramer.
Listen, he uses, I get it, man. He uses Yahoo Finance. I would expect nothing less, man. He's from the generation that rides on that shit. You know what I'm saying? It's cool. They should do what they do. Jeremy Siegel said inflation is basically over on Thursday after October's CPI report showed lower than expected inflation. But you see, the complicated thing is that inflation is now being split in various ways. I want to remind everyone that the definition of a recession has been redefined.
Oh yeah.
So how many more things are going to be redefined to meet inflation? It carries on to say, Siegel said investors should expect a significant year-end rally in the stock market as investors recalibrate their Fed expectations. Two things here. When they say a significant rally, think about it. We're down, the stock market has pulled back what? Most stocks are down what? Almost 80%?
70, 60.
70, 60?
Yeah.
A significant rally could be 20% up and you'll still be in a loss. In many
Especially
ways.
if you have some calls, some leap year calls.
Ah,
like
dang.
me.
Okay, yeah, so that there's that too. But then now the question becomes, if you were averaging down, was it a smart idea to be averaging down? And if you did not average down, you know, it's about
If you have
the
stocks,
portfolio
yes,
management.
it's fine to average down. But if you have options, I don't know, man. It's just, I don't think it makes sense to betray money down a manipulated market.
They say pedal to the metal until something breaks. You're not doing it right.
I'm not an extreme investor like that, man. I just cut my losses short.
Hey, guys, that's definitely that's also yes, that's a
That's
tough
my
thing to
strategy.
do. That's a tough thing to do, but it's something that has to be in a strategy.
Yeah.
Anyway, he says there is still a chance we can avoid a hard landing if the Fed pivots in December, but we know that the Fed is not planning to pivot in December.
Last month of the fourth quarter, what the hell? Who cares?
You know,
They might slow down. They're not pivot. Slowing down is not pivot.
exactly. They've spoken about slowing down, which slowing down is a different thing from pivot. And even slowing down, I mean, that should still drive the market
0.50
down.
interest rate instead of 0.75.
Exactly.
That's
That is
still an
that's still
increase
a
in
hike.
interest rate.
That is still a
It's-
hike.
Yeah, it's still a hike.
You know, so that's why I asked at the very beginning, who is this guy? What sort of economist are you? And have you heard about Austrian economics? That's where the problem lies. Now,
Well, I have to say though, compared to
Yes.
all the Harvard and it's from Wharton. Wharton economics seems to want to give you a view of the entire world and not just the Chicago economics.
listen, man, if they're an economics professor in the United States, there's no hope for them. There's no hope. Wharton professor Jeremy Siegel, right? He says he's encouraged by the CPI report. I know you have some data which you're going to be sharing with us here in a little bit double.
Yes, sir.
So we're waiting. Prime up your charts. The charge king.
It's coming.
So the CPI report, which was followed by lower than expected inflation, sent the stock market soaring on Thursday. Some other things that he also talks about in here is the fact that he wants the feds to use or to stop using lagging house data. So you could look at this information from various statistics, or in other words, you could align various statistics to give you what you want to see, essentially. And we're talking here about inflation at 7.9% according to them, which we know that I still think is higher than that. But inflation is supposed to be around what, 2%? I think they'll try to normalize this 7% thing as the new normal, man, and everything just becomes more expensive.
Good way to think about it.
We need to go back to 2%. Otherwise, we've all been robbed again.
Again.
You know? But carry on, sir. What are the data points that you look at?
Yeah, so I look at the markets to kind of come up with my summaries.
Yes.
So we're just going to look at the market first before we even look at the CPI data and whatever numbers they've cooked up. Well, some of it is cooked up, but again, they've changed the definition of what data points they should be looking at. But before I show you guys and go into details of all of this, let's remember first that we have the issue of we still have the trucker issues, the logistic issues, which could still contribute to inflation. We have the issue with diesel. The rumor out there is that we've run out of diesel, and there's not enough diesel for the truckers to move around. That's not an issue. There's also the issue of China with the revolution, or some sort of a revolution going on in China right now, where Foxconn and all these big warehouse developers or people that work in the warehouse are running away, trying to get their freedom from this old COVID isolation that they've put them in. Right. That is still going on. We still have a war in Ukraine, which is still impacting the price of food around the world and the price of oil around the world. That hasn't gone away, right? So the list of all the factors that impact inflation is still there. But the markets are showing something different, which is kind of where I'm kind of confused at this moment. This is why I'm saying that. So let's look at US 30, right? This is an indicator of all the top 30 US companies out there, right? And the green line is the 8-day moving average. The yellow and red line is the 20 and 34-day moving average. This is kind of how we look at some of our swing trades or some of our long-term trades. We use the 37-100 day for our long-term trades. That's also quite interesting. I'll show you guys in a little bit. But what we'll see here is an uptrend, right? And as a matter of fact, that blue line that you see there is the 200-day moving average. Once you start crossing above the 200-day moving average, this is super bullish. You see the same thing on the US 500. It's not there yet, but it's an indicator that we are getting close to it. The trend has moved up. We've had a few days where the market have crashed, but the trend is starting to move back upwards as well. And the VIX, right, which is the opposite, the volatility index, is pointing downwards heavily, to the point that even the RSI is pointing downwards as well. Interesting, right? Let's skip Bitcoin and STAKK, for example, for now. The 10-year yield has been increasing over a long period of time, to the point that it reached up to 434. I think this is major theft, unless you have billions of dollars in the bank account and you're just trying to preserve your currency. But that's still below the inflation rate. But that is starting to fall as well. So I think investors are going to start getting out of bonds really quickly, even if they have to pay a fee to exit too early, those that got in too late, to start getting into this kind of movements, because this is where the money is at. Look at the GJI, that's also crossing upwards. DIA pointing upwards. SPX still shaky, pointing upwards as well. NASDAQ pointing upwards. SPY pointing upwards. Now let's go look at the CPI data. That is a low number for October. 7.7 compared to all the previous months. We were dying. And by the way, this is how we calculate the CPI data, by the way.
So the CPI will be your consumer price index.
Consumer price index. Yes, they have modified some of these numbers so that it doesn't show. Yes. So that 7.7 is literally maybe like 12%, really.
Right. So here's my issue with these indicators, right? And all this data that we're looking at here. And I just want to combine it all, and hopefully it makes sense to some people. You have your consumer price index, which is CPI. That is what the people are paying for stuff. right? Then you have your producer price index, which
Yep.
is what companies pay for the materials that they use for whatever they're doing.
Yep.
Now, take into factor all the other things that
That's
you've
the
spoken
PPI
about
right there.
there,
Yep.
right? All the other things you've put in that you've also aligned there. Civil, what would you say? Civil unrest, right? In places like China, Ukraine, so on and so forth, right? These are things that are affecting the global economy. Then you also take in gas, oil and gas, diesel shortages in that area as well, which
Yep.
will make it more difficult and certainly more expensive for many things to happen. Things that used to be happening more fluently. So it is disingenuous, borderline FTX activity for leadership to remove the numbers that are affecting people the most and then display whatever that they want to show that this, because like I said in the beginning, right, you can find whatever numbers you want to align to get the narrative that you want
Out there. Yeah.
out there, right? And so the other part now is you've also shown some charts here from the stock market, right? And when you look at the things that are happening, right, and how the economy is supposed to react to it, it's become very clear that the economy itself and the markets are now disconnected, because the markets are supposed to be a direct representation of how the economy is performing, GDP, all of that kind of good stuff.
Yeah.
It makes no sense. These two things are driving in different directions right now.
But you see, the big companies are doing major layoffs. Amazon, Microsoft, Facebook.
Which means if there's major layoffs, I think great point there. If there's major layoffs, this means productivity is down.
But profitability goes up.
No, because productivity is down, inflation is up, which means that consumers are not spending as much. Where are these people spending this money?
No, but you have to, if you think of it from the business point of view, you're getting a lot more out of less.
I understand. But who are they selling the products to?
The consumers.
The consumers are not buying. Spending is down because the recession is coming.
Data shows that. We're just
Interest
looking
rates
at
are
that.
rising. Spending is down, so the
Yeah, there's
productivity
actually
is not there.
data that came out on Friday that people are going to lesser store like dollar stores and
Yeah.
Walmart more often than the more expensive
Exactly.
stores.
Exactly.
As a matter of fact, Tom Ford is selling their store to another company because I guess they're not making enough sales at the moment.
If you're not producing like you previously did, if you're cutting jobs, which means you're making more people broke, which means more people are nervous, and which means more people are going to be holding onto their money instead of spending it, right? And there's all this global unrest. When you look at China, China was producing most of the goods that are shipped around the world. Not happening anymore. Ukraine, a lot of food, right? Wheat and things like that was coming from there. Not happening anymore. Then you also look at oil and gas. How is Europe
BRICS
still even
and Saudi
surviving?
Arabia. All right, I have this though. I have this to
Go
say.
ahead.
COVID happened, right? And I
Yes.
feel like there's this big division of wealth where a group of people are crashing and a group of people are making a lot more money. And my argument is that Bitcoin will be at 30K right now, given those kind of movements, if not for
Yeah.
FTX. But think about it. There are those that invest their money and there are those that spend their money. There are the bankers that make money no matter what happens to the markets, and those that just don't have the money at all. I feel like the privileged or people that have access or the knowledge might take advantage of this short-term market boom before the reality hits the markets. No, there's the main streets and the markets. Markets might pump just like the markets pumped during COVID, whereas the entire main street was crashing. People had no jobs, but people were still investing. Well, people say, oh, they got money from the government, that's why they were able to invest. That was not a lot of money. The people that really got the money were the big institutions. Your $1,500 check from the Fed is not enough to make any movement in the markets.
Exactly.
So what I'm trying to say is that I think that there could be a market boom, even if it's short term, and a lot of people are gonna, well, not the population, but the investors are gonna take advantage of that move.
There is a possibility for that. I see what you're saying. But I would say that if there is a market run, I think that is a completely engineered bull run. It's not a reflection of the economy,
Correct.
which is
I agree.
what is supposed to be an indicator of. But that's all I have. Final thoughts,
Yeah.
sir.
Hey, today was quite interesting, by the way.
Man,
And if
it's
you like
awesome,
this, leave a comment. Let us dig a little bit further if you want us to. We try to keep things simple for the common people here.
Listen,
Check
man,
us out
I
on
try to keep
STAKK.
things simple because I can only understand simple things myself. Okay, I'm not Mr. Jeremy. I'm not a Wharton whatever. I never went to Wharton, Harvard, any of these other things. I'm not mathematically inclined in that manner. You know what I'm saying?
Oh, Lordy.
But listen, I finished high school, and that's thank God that's all you need to understand basic economics, bro.
Hey, I tell you, the wealthiest men people in the world right now, a lot of them did not complete any of this. I do like Wharton though. I would check Wharton out before I check out Stanford.
Oh really? I'm not going to any of them, bro.
I would like to go to Wharton one day.
No, I dropped out of college for a reason. It's a waste of time. But you know, it is what it is, man. Look, the internet is the greatest university ever.
Yes, sir.
It's all there. Remember, I told you, man. I was watching some stuff from what is that school up north, man? MIT.
MIT.
Yeah,
MIT. Yeah. You've uploaded yourself up on some MIT economics
Listen, get on YouTube
for like 2 months straight.
look up MIT, and you can take all the courses for free while sitting on your couch, feasting on whatever people eat these days. I think most people are vegans now or something.
Thanks to the World Economic Forum. By the way, talking of free, you can always check us out for free on Facebook, on Twitter, on YouTube, Instagram once in a while, and of course podcasts.
Yes, absolutely. Until next time, ladies and gentlemen, brazen out.
Double O.